throughout this week, Russian foreign exchange gold has been trading, as I say, around 200 rubles above the ruble floor into a rising ruble cross rate, regardless of the official interventions. The floor has been netting out to between somewhere around 1920 to 1950 per ounce. Now that will vary, depend on the exchange rate. That's why the exchange rate is so important. And that's why officials were trying to attack that exchange rate.
Now, Andrew, I promised everyone at the beginning of the show this would be fascinating, and never did I think that we'd be talking about the ruble of all things, but this is interesting. Now, how does all of this, these developments, value gold, let's call it in the short and maybe even into the medium term? What are you seeing?
Yeah, I think the first thing, let's assess the fresh short-term ranges, because a lot of people are trading this and want to know kind of where the ranges are, where's best to get in and out. And obviously, if you're a stacker, load up. I mean, honestly, there's just it's no discussion. But there's a lot of people using this kind of information that you can gather anywhere, but kind of melding all that information together to figure out, well, okay, well, where's the best places to be? And I'm not saying, I'm not telling anyone to take a trade. What I'm saying is we need to look at the ranges so that you can make best informed decisions. But we must look at the heavily gamed, after non-farm payrolls, which was last week, we look at that action to evidence really how officials are limited, because normally in a situation like non-farm payrolls, we would have seen a huge crash, but they were limited as to what they can do to fight a tidal wave of outflows of paper market liquidity into a rising physical market floor. Now, with Russia having invoked the gold ruble nuclear option, it's become evident that officials are attempting to intervene in the US dollar ruble cross. But as we discussed in our last episode, the blowback effects from trying to fight an ongoing gold suppression war by selling paper gold into such strong physical demand and related supply shortages is just not factored in yet. It's not realized. It's not priced in. Instead, it's widened the gold window for sovereigns and central banks to exchange their debasing dollars for physical gold well below supply-demand fair values. Now, officials have very little else to employ than an ongoing PSYOPs war. We talked about the PSYOPs war last time, and we expect some official foot stamping, of course. Arbitrers will just jump on the opportunity into a guaranteed physical buyer. Now, while it is Russia that's guaranteeing to buy gold at 5,000 rubles per gram, it's nevertheless setting a global benchmark price. Regardless of US efforts to block China bolstering the ruble with gold, there are far too many back channels that flow back into Russia that just simply cannot be blocked. Now, this 5,000 ruble exchange rate is actually trading more. Anyone looking at that will see that it's actually trading about 200 rubles higher than that. Why? Because there is a fee to refine the gold and basically bring it in. So you'll see that it's pretty much 199 to 200 rubles higher than the benchmark price, whereas the ruble, the spot to ruble price is actually higher than that. Now, you know, these are all the things that we look at. This is what liquidity providers look at, and this is what tells us that really this is a game on for a much higher price. Now, we're recording this episode 2 days ago. This will be Friday when you get it, so it'll be 2 days ago on Wednesday, the 6th of April. And while we have evidence some official interventions in the ruble, US dollar ruble cross, throughout this week, Russian foreign exchange gold has been trading, as I say, around 200 rubles above the ruble floor into a rising ruble cross rate, regardless of the official interventions. The floor has been netting out to between somewhere around 1920 to 1950 per ounce. Now that will vary, depend on the exchange rate. That's why the exchange rate is so important. And that's why officials were trying to attack that exchange rate. But this is why the active, seeing this price and the paper price opening this window to exchange, you know, dollars for gold at a discount, That's why the at-market buyers, remember we talked about at-market buyers, we've talked about them in every episode, and since February the 28th, they have turned up at market at every PM fix. And the arbitrage opportunities of buying this EFP paper gold and demanding delivery and capitalizing on the difference is just far too attractive. Today, liquidity providers are pricing gold at around 1940, which will bolster more at-market PM fix attendance. Well, where are we at the moment? Okay, so we're looking at roughly in futures terms around 1930 at the moment. So it's making it attractive. And the forward curve on this arbitrage trade is anticipating the US dollar cross closer to 70, as we said. That is the general consensus, raising the floor really to 2200, even based upon on an even higher exchange rate. In other words, an even weaker exchange rate. And if the arbitrage floor is plus 200 above 5,000 is maintained, then really that equates to around about $2,320 per ounce. So, you know, this is why are you going to sit back and not take advantage of a paper market that's offering you gold well below the price? So what we're saying is, look, yes, there's the paper market specs that can get rinsed. And you chase a few averages and yes, you can rinse the paper market. But dips from here on will be limited as to how many paper market specs can be rinsed. Insiders do not want to be exposed to physical delivery obligations. It's quite the opposite. They will be seeking to rid themselves of any shorts into this unfactored situation. So really very short term, to answer your question, Shane, we've evidenced official interventions, which in plain vanilla form has driven the gold price floor down at as low as 1870. That was into non-farm payrolls, and higher in 1920. This is the floor, higher back to around 1920 this week. However, liquidity providers report that sovereign buyers are, as I say, basing 70 as fair value, which prices gold well above the floor, above 2200. The effect on the derivative markets on a gold price above 2000 are not factored in. There's a hell of a lot of year-old and more options bets that say that 2000 is where you're forced to delta hedge and buy your shorts back. Now, the last episode, we looked forward at remember we had BIS OPEX expiry going to be coming, and we suggested it was going to be limited to how much paper fluff that could be rinsed out. This is why we assess that insider short cover is really now limited to what they can rinse without exposing themselves to delivery obligations into options, limiting the downside as paper discounts will be, as I say, capitalized through the EFP conduit for delivery. Physical supply, I cannot underscore, physical supply is so tight that these swaps of paper physical are now reaching into, this is really important, reaching into the GLD unallocated flywheel. Now, we have not seen this since March 2020. And back then, we had everyone on the same side of the table, and the LBMA came in to protect the market. Not this time. We have predators coming in and saying, where's my gold so I can play the arbitrage trade? So they're going into this GLD. And as we've been highlighting, and obviously this is size, because you have to have size, you have to be a size player to even get delivery through the GLD, through the authorized participants, who are the likes of JP Morgan, etc. Now, as we've been highlighting, this paper to physical conversion is being driven by sovereign size buyers active at every single PM gold fix since late February. So no matter what the price is, this is draining paper market liquidity.